Where do I start? Julie Andrews once sang, "You start at the very beginning. It's a very good place to start." So going back to the beginning of the week, the markets were focused on banking crisis. We had Silicon Valley Bank, which was still looking for a buyer. Signature Bank found a buyer. Credit Suisse also found a buyer in UBS, or a forced marriage at least. First Republic remained a key concern, but U.S. banks were trying to come to its rescue and at least prevent a run on that bank. We also knew that the Fed would be speaking after their forced quiet period. That is a prelude to the FOMC rate decision, which would take place at 2 p.m. on Wednesday. And on Wednesday, the Fed did speak and raise rates by 25 basis points to 5.0%. They also projected that the terminal rate at the end of 2023 would be 5.1%. That was unchanged from the December projection. So in addition to raising rates this month, the Fed now saw an additional tightening of about 25 basis points, most likely at their May meeting. What did the Fed see going forward as far as monetary policy? Well, in 2024, they project that the end of year rate would come down to 4.3%. That was up from 4.1% in December. So the Fed does see a move lower in rates, but not until next year sometime. What would the economy be doing to get those rate projections? Well, the Fed saw GDP coming in 2023 at 0.4%. By the way, the Atlanta Fed GDP Now tracker came in at 3.2% for Q1. I guess that explains the additional 25 basis point hike that the Fed is looking to do in May. On unemployment, they see the unemployment rate moving from 3.6% to 4.5% by the end of the year. I guess that fits the story that 5.1% will be the terminal rate in May. It also fits the Fed storyline that they would keep rates unchanged for a while after reaching the peak and not start to ease until 2024 at some time. After all, they don't want a repeat of the Volcker years when he started to ease too soon and had to reverse policy. On inflation, they see core PCE moving down to 3.6% by the end of the year. The last core PCE released in February, at the end of February, was still at 4.7%. We had a recent CPI report at 6% with the core at 5.5%. Everyone and their brother sees inflation coming down, with the storyline of how shelter would lead the way because of the way it is calculated. The shelter component of CPI in the last report was still up 0.8% for the month. These are the last 7 monthly increases. I don't see any inkling of a slowing. Do you? At some point, a 0.3% or 0.2% will likely come out for that shelter component, and there will be a chorus of "I told you so's." But let me remind you, after a couple of 0.2% and a 0.1% in the headline CPI, the last 2 months have seen gains of 0.5% and 0.4%. Sure, it isn't 0.8%, but it is still 0.4, 0.5%, well above what the Fed is targeting. The good news for the Fed is that it is not the UK, where CPI inflation rose to 10.4% year on year this week, from an expected 9.9% when they announced that measure on Wednesday. The BOE raised rates by 25 basis points and gave a balanced bias, with BOE's Bailey saying that he was not sure if 4.25% would be it for the terminal rate. That is a story for another day. Anyway, the U.S. debt market reacted to the idea that there was more tightening to go by the Fed by not taking rates higher, but lower instead. The U.S. 2-year yield moved from 4.18% on Wednesday to 3.55% on Friday, before moving back up to 3.77% by the end of the day on Friday. Recall earlier this month, the 2-year traded at 5.085%. That's a big move in 2 weeks. The 10-year yield moved from a high on Wednesday at 3.64% to a low on Friday at 3.287%. It closed at 3.503%. The high in March for that issue was at 4.09%. So clearly the market is saying, thanks, Fed, for your thoughts. This is ours. Rates are going lower. What you think does not matter. Of course, there are other storylines with Deutsche Bank becoming the bank du jour that is in trouble. That may be sending the flow of funds into the debt instruments no matter the yield. However, at the same time, the stocks in the US, Europe, and Asia Pacific moved modestly higher by the end of the week. So there is not a lot of flow of funds out of the risky stocks. So we have this disconnect with what the central bank like the Fed says and what the market is doing. Maybe central banks deserve it. Maybe the market is saying, we will solve your problems. Maybe the central banks want them to solve their problems, at least in the short term, as they have this mandate on inflation. Inflation is still too high. So the idea of we have our tools to stop runs that are our financial tools, and we also have these other tools over here that are our monetary policy tools that slow inflation. We have no choice but to do what we're supposed to do. That is, keep rates high, keep moving them higher. Then over here are the markets. If the rates move too high, making bond holdings at risky banks underwater, then have the healthy banks provide a lifeline by buying bonds and lowering rates, and give those banks a lifeline to a do-over, that is, get out of their risky positions. The healthy banks may have the liquidity to do so. After all, the banking system is getting gummed up. It is no secret that banks are tightening their loan requirements and may be becoming more restrictive in their lending. And that may be the straw that breaks the camel's back as far as the economy. All things being equal, if banks have funds that normally go out to loans, but those loans are slowing, those banks can buy U.S. debt instead. Hence, rally the 2-year or the 10-year debt instruments and bring rates lower. At least those healthier banks are not buying 10-year bonds at big figures in the 1% or 2% range like the Silicon Valley banks of the world were doing and not managing. So overall, the spaghetti is getting shuffled around the plate in a big-time way. It's central banks and mistakes. It's fiscal policy and their mistakes. It's the pandemic hangover or the supply chain hangover. It is inflation, which does not benefit anyone. It is poor risk management. It may be modern bailouts by banks themselves. After all, JP Morgan did not benefit from saving Bear Stearns in 2008. So why not rally bonds instead, lower rates, and solve some of the problems in the markets by just doing that? So where do I start? It may be at the beginning of a point in time like last weekend, but the end is continuous and full of all sorts of ingredients that go into a recipe for rates, for stocks, for commodities, and Forex too. We may be cooking a soup one day and a souffle the next. As a result, I think we will continue to see increased volatilities in the market. To me, that means you must understand what the price action is telling you and have the mindset that things can and will change. Technical tools go a long way in doing things like defining a bias, bullish or bearish, defining risk on where you are wrong, and targets on where you are right and where you are looking to go. In the next video, I will outline what levels are in play in the major currency pairs so you can answer those questions yourself.